while I am
So
getting my
I do
screen in
my
place.
Good afternoon, everyone, and welcome to Justine Peterson Presents Illinois Ignite Illinois. I had it backwards, but I'm so glad you all are here. And this is round 4. Oh my goodness, all the information up to date has been amazing. We have Nate. Come on, Nate, with tax strategies for maximizing profitability. I'm going to turn it over to you, Nate.
Thank you so
You're
much,
welcome.
Yolanda. Thank you everyone for being here. And people think taxes are boring, not when you're making money. That's when it gets exciting, when you can learn tax strategies and benefit from them. I've been in the tax industry for over 30 years. We've had the Income Tax Center, and you may have heard from some of our team members, Ann and Shalita, if you've been on the other ones. And so now we're going to get into tax strategy, and then later we're going to do advanced tax strategy in a few weeks. We're going to cover some marketing and some other aspects of your business so that you can have a healthy, thriving business. And a lot of people don't know or think about taxes as much as they should because they don't see it on their balance sheet or their income statement, but it's actually one of the biggest expenses you have. And so we want to limit the taxes. Our philosophy is not to pay 1 red cent more than you're legally required to. And so as business owners, we have an obligation to be savvy with our taxes. So what I'm going to cover today are different aspects of how to, hey, Ann, I'm glad you came on screen. When it comes to taxes, the tax code is, last time I checked, over 6,871 pages. So it's voluminous. By comparison, the Bible is about 200 pages. The tax code changes, the Bible doesn't. So you can imagine if you can't memorize the Bible, the tax code is something that is always evolving. So what we're going to cover today are different aspects of deductions. It goes on and on and on, but these are some key ones, I believe. And then on the advanced tax strategy, we're going to talk about some aspects of the Big Beautiful Bill and some of those provisions and how they work with advanced tax strategies for business owners. So you definitely want to catch that one as well. Everything that I say to you today, I want you to think about from the perspective of these are wide-ranging net, if you will, tax strategies and tax planning. You want to speak with a tax professional. You want to speak with a tax pro about your individual situation with all of these different tax strategies because they are based on you and your life. So I'm going to go ahead and hit share. I'm going to show you my screen. We're going to dive right in. This is interactive, so I love to get some chat in the chat area. Some of these, I have some trivia questions as we go through, and I love to just get your feedback on it. This talk is called Render Unto Caesar. Render unto Caesar what is Caesar's, and what is God? God. So that's we want to render under Caesar not 1 red cent more than we're legally required to. Amen. So here's how we start. Each one of us as business owners, we probably fit into one of these 4 categories. Now I want to see which one you are. If you can put it in the chat as I read these off. You are either A, goody two shoes. You pay all your taxes on time, maybe even early. And if the IRS makes a mistake in your favor, you promptly correct them and send the correct amount of money to the IRS. If that's you, put goody two shoes in the chat. I don't know how many people are goody two shoes, Ann. I don't know. What do you think? Not very many.
No, not
Maybe.
very many.
Maybe. Oh, look, we've already got it, Dr. Dredd. Read ahead. Dr. Dredd, taxes sometimes give me anxiety, but more than not, they are a nuisance. I do what I have to each year. Move on. Life is too short to stress about taxes. Are you Dr. Dredd? Number 3, don't judge me. Taxes are evil. I like to stick it to the government every chance I get. So sure, if it means fudging a bit on my taxes, who cares? They stick it to me every election. Besides, everybody is doing it. Are you don't judge me? I don't know who's brave enough to put that in the chat. Next one and last, dirty deeds. Basically, if I can get away with it, it is legal. I underreport income, overreport expenses. If they catch me, they can bill me, but if they want the money, they'll have to kill me. Wow, dirty deeds. I don't know if anyone would fit that bill, but That's usually the four kinds of taxpayers that we run into when we're dealing with taxation. And business owners, obviously, you don't want to be a jump. That's right. You don't look good in an orange jumpsuit. That's right, Teresa. That was you. You just beat me to it. I always tell clients, I don't look good in an orange jumpsuit, and you don't either. So let's do things the right way. Let's find the tax breaks, and let's go ahead and make this experience that no one is going to go to jail for. Here's some trivia question for you. I love to just kick it off with a little bit of trivia. The income tax was permanently legalized. The income tax hasn't always been around. It's ebbed and flowed. What it was A, B, or C? What do you think that the income tax was permanently legalized in the United States? 1861 Revenue Act, 1894, or 1913 with the 16th Amendment? What do you think, A, B, or C? When the income tax became permanent and we all got stuck with a tax bill every single year. Which one do you think it is, A, B, or C? I got a C. What else? Come on, everybody. Have some fun with this. What do you think? I want to see if you got it right. Another C.
I'll say C.
Okay. Yeah, you can always yell it out too. It's fine if you can't type in the chat. C. We got a lot of C's in the house. A lot of C's in the house. Well, if you're thinking A or B, it's too early. They did come in, but it went back out. And everyone who said C, give yourself a star. 1913 with the 16th Amendment, we have now permanently been stuck with taxes. Raise the roof if you got that right. In fact, and I'll maybe talk about this a little bit later, 60 to 70% of all taxation is derived from individual taxation. So in terms of our trillions of dollars, $4 trillion in our annual budget for running this government, it comes mostly from folks like you and me, as you can see. All right, here we go. We're going to top 12 tax tips. Number 12, I'm going to go right into the heavy lifting first and get it out of the way. People always ask, one of the big questions, should I be a C corporation? Should I be an S corporation? Should I be an LLC? And this is a very common question. This is something I won't dive deep into because this is an hour-long talk, if not longer, just in and of itself. But I'm going to give you just the highlights of it. If you're an LLC, it's better than being a sole proprietor, just to start. If you're a sole proprietor and you say, you know what, Nate, all I did was I went to the downtown and I got my fictitious name and I'm a sole proprietor. Well, for tax purposes, it's the same as a single member LLC, but then you don't have the protection, the limited protection, limited liability, which is really what an LLC is, right? Limited liability company. So you definitely want to talk with your attorney, your legal counsel about the legal ramifications of that. And LLCs are super easy to set up. As far as taxes go, if you're a single member LLC, flows the same way as a Schedule C, what we say in the tax world, which is a sole proprietorship. Now, people say, should I be an S corporation? Well, there is a benefit to becoming taxed as an S corporation if it makes sense, if you've got employees or if you're not responsible for 100% of the net profit generation, then it may make sense. And again, these are conversations to have with an accountant who's proficient in this area to be taxed as an S corporation, because what happens then is that you have a tax shelter of all the Social Security and Medicare, 15.3% tax, that you're not laboring for. So if you're an LLC, single member, or even a partnership, then in most cases, if you're active in the company, you're going to be responsible for all that. So say you made $100,000 in the company and net profit, then you'd pay approximately $15,000 in self-employment tax. But what if you said, Nate, my reasonable labor for this company was $50,000. The other $50,000 of net profit was generated through the labor of others. Well, that's when you may consider the S Corp election, because then you may be able to save $7,500 in tax. There's so many other factors to that. C corporations go into a whole nother level. You subject to double taxation, but there's some ways around that as well. These are questions that you need to have with an accountant. We do a lot of entity, what we call optimization strategies, and we'll talk more about that in depth and during the advanced tax strategy route. If you currently do have an S corporation, and you are not quite sure if you're utilizing it properly. If you're not sure if, hey, I just don't know if I'm making enough sense of this, and if I'm maximizing it. I don't even know if I'm taking a reasonable salary, because the government requires you take what's called a reasonable salary for your labor. You can't take distributions in lieu of salary. That would be an abuse of the tax shelter. Then you want to talk with somebody, because it's a big deal, and we got to get that number right. And there's so many other factors, but definitely get it on your radar. Get it on your radar to either consider it or have a conversation if you're maximizing its benefit. Okay, 100% want you to do that. Yes, thank you, April. You definitely. I've had so many people come to us and say, my accountant told me I need to be an S corp because I'm going to save money. And then they ghosted me, or that was it. And I don't know what to do now. It's almost like you got a super suit and you don't know how to use it. So that's definitely a conversation to have with an expert, so we can make sure that super suit is being utilized. All right, number 11, Augusta rule. People say, I've heard of it. Has anyone heard of the Augusta rule? You can say yes. If you've heard of the Augusta rule, I've heard of this Augusta rule. What is that? What is that? And most people have said, no, I've never heard of it before. What's the Augusta rule? Well, this is a wonderful tax strategy for business owners when you rent your home tax-free to your business. Say, for example, you had a meeting at your home, whether it's a client meeting or maybe a company event, training event, so on and so forth. The first 14 days of renting your home are completely tax-free. In other words, your business can pay a fair market value for the rental of that home, or it could be an area of the home. And then business takes a write-off. In other words, they deduct the expense, and you claim the income, but not until there's 14 days of usage. So in other words, you can use your home up to 14 days and not pay any tax on that income, but you get to expense it all for your business. It's fantastic. So say, for example, it's, I don't know, throw a number out there, $10,000. Nate, okay, $10,000. Well, it's $10,000 of income that I don't have to pay taxes on. I don't know what the number is for you. When we do it for Augusta, we actually do comparative analyses of what places for rent for example, meeting spaces for rent are in your area. We use that same measurement, square footage, time. We're very meticulous about that process so that we're IRS compliant. Of course, there's some caveats, and I'll have these slides available for everyone who's registered, so that we can make sure that you get these, because it's really hard to understand everything. It's like drinking from a fire hose with taxes, and it's hard to write all this stuff down. So I'm happy to provide this to you. So all these notes, you have to be an S corp, a C corp, or a partnership. Can't be a sole proprietorship or single member LLC to receive it. So again, back to that super suit, right, of different entity optimization strategies. Can't just be, hey, I'm just writing it off. It has to be legitimate business purposes, a genuine business reason, a board meeting, a company retreat, some kind of a planning session. What's really fascinating about this Augusta rule is most business owners are likely already doing this. It's not that you have to think about it. It's already happening through the year, and it just has not been documented properly. So we want to make sure that we document that and take advantage of those tax deductions. All right, so Augusta rule, get it on your radar. Talk with your tax accountant, talk with your tax strategist. But unfortunately, most tax preparers are not tax planners, because it's a different hat you wear. So if you've got a tax preparer, sometimes they just don't know about how to implement these strategies, because it's a planning strategy. It's a planning exercise. So you definitely want to communicate with tax strategists, tax planners, who then understand these concepts and are able to help with this process. All right, that's Augusta. Number 10, people don't realize about giving, how impactful giving can be from a tax perspective. You've heard of charitable contributions and, of course, deducting them. And a lot of people say, well, I can't deduct them anyway because I don't get to the threshold, things like that. However, you may be able to get to the threshold based on other kinds of giving In other words, you can give your appreciated security. So you say you may have a family member, you inherited some stock, and that stock is worth some money. But if you cash that stock out, you're going to pay capital gains tax. Well, you could donate that to a qualified charitable organization. You could be your church, could be a religious institution, and then you get the full deduction and you pay zero capital gain on all of the money that stock has made. That's one way to do it. Now, check this out. What if you had business assets that you're not using anymore? Printers, desks, copy machines. We had all of these back in the day. We were in the malls. Anna remembers the malls. We had these fold out walls. I had so many of these walls. We had 7 malls at one point, and I didn't know what to do with them. I went ahead and donated them. Well, I guess what? That donation turned into a charitable contribution out of my business, and that turned into dollars back to me. So there may be assets that you have in your business right now that you're not utilizing that you could turn around and donate. Don't just throw stuff away. They may have a actual cash value that you can use for business deductions and donations as far as assets. So that's really important to know. So if you've got any type of assets like that, you say, Nate, right now I don't have stock. Right now I don't have any of those things. Okay, but one day you may. One day you may say, you know what, we're cash flowing with the business. I need to diversify. And so what we do, not only do we do tax planning and tax preparation, we do what we call tax efficient wealth building. Now, I grew up poor. I don't know about you guys. I grew up poor. And one thing that I can tell you from me growing up, and there's no disparage against family, but I was never taught about money, how to manage it well, and how to have tax efficient wealth building. I had to learn it on my own. And I want to make sure that the clients we have don't miss out on that, because eventually, Lord willing, you're going to have more than you can use. And then you want to invest it and help it to grow tax efficiently. All right, number 9, end of the year shopping spree. Everybody asks, what should I do? We're getting close. You say fourth quarter is around the corner. Should I go buy some stuff? Everybody always wants to know. You ever ask your accountant? You ever ask, hey, do I need to go buy something before the end of the year? Very common question. Should I go buy that Ferrari? Well, I would say definitely don't buy the Ferrari. Unless you're going to take me for a ride in it. Maybe a Mustang. I like that. So here's my philosophy on buying things at the end of the year. I think you absolutely should purchase everything that you're going to purchase at the end of the year, not for the purpose of saving on taxes just because you bought something, because I wouldn't want you to buy something to then have it just sitting there and no cash, right? So you say, Nate, I bought this piece of equipment that I'm not using, and now I don't have the cash. Well, I'd rather you have 70% of something's better than 100% of nothing, if that makes any sense. So don't just buy something to buy it. Buy it because you're going to use that asset. So if you're going to, here's my philosophy. As you get close to fourth quarter and it's coming right up, think about everything you're going to need in the first quarter. Think about everything you need January, February, and March, and that you would put it in use in the end of the year, then buy it in November, December, and put it in use in November, December. That way you get the tax deduction one whole year earlier, because $1 today is always worth more than $1 tomorrow. So you get to use that cash. So say, for example, you've got $10,000 worth of equipment you were planning on buying in January. Well, buy it in December, use it in December, and then we got the $10,000 write-off in December, which means, say you're in a 25% tax bracket. That's $2,500 that you get to use all year long that you wouldn't have had access to the year before. So that's how I want you to be thinking about when you're thinking about buying things at the end of the year. And then this next tax planning talk, we're going to have the advance. I'm going to talk more about 100% bonus depreciation. I'm going to talk about the new tax provisions that allow you to maximize deduction. So we'll go into that in a lot of depth. This is just an overview on that. So buy the Mustang by the end of the year. If you're going to drive, and you got to drive that Mustang. And if you buy the Mustang, you got to buy the 8-cylinder. You got to buy the 5.0. All right. There it is, GT. Oh, somebody knows their Mustangs. All right. Hey, here's some trivia for you. I want everybody to jump in here. Fact or myth? Your neighbor, your coworker, your bus driver or your manager should have the same tax outcomes as you. Angelina. Fact or myth? Fact or myth? Mm. Mm. Oh boy. Why did I put that in there? I know it sounds silly, but we get that question so often. Well, my neighbor got back $5,000. My uncle didn't owe the government, right? All these questions, everybody has a different tax scenario. The tax scenario is so complicated. I mean, even if you're just a W-2, let me see their tax return. That's right. That's right, Ann. Even if you're just a W-2 employee and you don't have any self-employment income, withholding and kids and mortgage interest and education, and there's so many factors that go into it. So what's really most important, the fact isn't whether or not you should have the same refunds or the same balance due. The fact is, do I have the right people working for me and helping me to maximize my tax savings? That's what we need to be focused on. All right, great question. Number 8, smart business travel. I actually took this picture myself back down in Disney. I asked this couple if I could take this photo, and it's perfect. Best day ever is what she said. Most expensive day ever is what he said. It is expensive. Have you ever been down to Disney World? Woo! Bring your Discover card. That's for sure. Smart business travel. You know, guys, something that's really underutilized in the business world as entrepreneurs and business owners is how we maximize travel for business use. For example, if you have a bona fide business use in an away destination, it has to be ordinary, necessary, and reasonable. Now, those 3 words you're going to hear me say throughout our time together: ordinary, necessary, and reasonable. Ordinary for your line of work, necessary to either procure or maintain your client base, and reasonable for the kind of work you do and for the kind of activity it is. And so how does that work? For example, this Disney trip. Well, there's a tax conference every year in Orlando. And the tax conference is, of course, accountants love to go to that. And of course, oftentimes they bring their families. IRS knows this. They lure us to Orlando. They lure us to this tax conference. And they know, because we know the tax law, and we can deduct the travel there, the travel back. We can deduct the hotel time during the conference, a day before, day after, and meals. You see, that it gets to be a pretty big deduction. And then we get to enjoy our time with our family, and the personal time. We don't write off on the business expense. We write it off on the personal expense. Well, that's okay, because now maybe half of that trip is now fully deductible to the business. That's pretty impressive. That's fantastic. So I would encourage you to think about when you're planning any type of travel for the year that may have a personal need, to consider, is there a bona fide business activity, whether it's a seminar, a workshop, something like that, that I can do? There's a lot of caveats to that. There's a lot of different things that are prohibited, different types of like cruises and different types of things. So again, this is a talk to a professional and get the lowdown. Don't just go to Instagram or TikTok. Find somebody who said something for 30 seconds, because that could get you in jail. All right. Next, put the kids on payroll. You know, if you've got children under the age of 18 and they are helping in the business, and you can really have a wonderful tax benefit for putting the kids on payroll. And how does that work? Well, the first $15,000 of earned income for a dependent, like a child who's under the age of 18, or really anyone, is tax-free for them, federal and state. If they are paid by your LLC, that's not taxed as an S corporation or partnership, then they don't pay Social Security and Medicare either on all of their earned income. They don't even need to necessarily receive a W-2. You can, in the certain circumstances, we do. However, it's a great tax shelter, and it's a great way to teach kids how to be savvy with their money. So, and it's a great way also to put them to work and get them to do some things. So whether they're washing the company car, taking out the trash, doing janitorial work, some administrative work, kids are great now with technology. They're great with social media. I mean, they can run circles around us old folks when it comes to all of these systems and tech. And if you've got any children that are still young in the house like that, under 18, definitely talk with your professional about putting them on payroll, because if you can tax shelter $15,000 per child, boy, you're talking some big bucks, especially if you have a larger family with kids who are perhaps teenagers or even younger, depending on the role that is bona fide and they're able to do legitimately. So definitely take a hard look at that. You can also, here's another beautiful benefit to that, is once they have earned income, then they'll qualify for a Roth IRA. And you can start putting money into permanent savings for them that will multiply and compound possibly with their interest earnings over time. And I never learned that when I was a child. I learned, when I was young, I didn't have all of that savviness. And had I had that, then maybe it'd be a different story long term with how I was a financial steward. For example, if you put $6,000 into an IRA for your child, you say, Nate, I don't know if I have $6,000. Okay, well, $1,000, whatever it might be. 7,000, and the cap keeps rising every year. But say it's six. Say it's six, and you're able to do that. And say they're 8 years old. Well, by the time they're 18, maybe they go to college, maybe they don't. You let them start doing it on their own. Instead of buying those big rims like I used to in the boom box for my car, just putting that $6,000 in and letting it compound. By the time you're 65, at a rate of about 6 to 7%, it will have grown to between $3 and $4 million, with about $300,000+ of investment. It's amazing when we learn discipline and control. It's amazing when we learn to have impulse control and save first before we spend, and watch the wealth rise. That's how the wealthy do it. And so I would encourage you to be thinking about that. And again, talk with somebody about how you could benefit from putting your kids on payroll, even if you don't do a Roth, to tax shelter some of that money.
Is there
All
someone
right.
that will be able to assist us in that as well, or to lead us?
Absolutely. Yeah. We'll make sure we have our contact info for being able to help you with that. Thank you for asking, April.
Okay. Thank you.
You bet. All right, here's some more tax trivia. Let's get involved here. This is not just the Nate Salah show. How much is the tax gap? Let's see if you get it right. The tax gap is basically the gap between what the government is collecting and what it should collect. In other words, people underreporting income, overreporting expenses, not filing at all because they owe. Is it 7 billion or 700 billion? Which one is it? Go ahead and put it in the chat. I'd love to see what you come up with. See if you get it right. See if you get it right. We got a 700 from Yolanda, I believe. Any other takers? All right. 7 billion or 700 billion. What do you think? That's the amount of money that the government should be collecting versus what they are collecting in taxation. We've got some sevens. We got some 700s. All right, they're coming in. I'm just going to go ahead and tell you, it's alarming. It's going to be $1 trillion before you know it. It is, in fact, $700 billion. Yeah, that's the gap. That's the gap. What could you buy with $700 billion? You had that put in your bank account. Oh, that might change a few things here and there, right? A lot, right, Andrew? All right, moving on. Number 6. All right, here we go. Become a fresh start Jedi, a defibrillator. I heard that. Amen. Well, we'll just pray about that. Become a fresh start Jedi. Let's see here. Oh, you know what? Okay, let's talk about this one. Sometimes we don't pay our taxes on time. Sometimes it accumulates. Sometimes it's just too much. And we find that we get behind with the government. So you might say, oh man, I owe $1,000. I owe $5,000. I owe $10,000. I owe $20,000. We've seen all the way up to $1 million in taxes due, if not a little bit more. And sometimes people can't pay it. And people have heard of the Fresh Start program. It's called an offer in compromise. And I wanted to just bring this up because I know some folks may be in the situation right now in their business. They're like, hey, you know what? I didn't realize that my self-employment tax was going to be so high when I started my business, and now I'm running a debt. Well, this particular program allows you to potentially offer a compromise. That's why it's called offer and compromise. So you say, hey, government, I want to offer you a settlement, essentially, and to wipe the slate clean. And there's two criteria that the IRS uses, and it's all based on this overarching doubt of collectability. So they have to doubt that they can collect from you, and that's from either your asset base and or how much income you have coming in. You might say, man, I had a couple of good years and I made a ton of money, but man, I didn't realize my taxes are gonna be so high. Now I own $50,000 and now my business is struggling and I can't seem to pay that. You may be a good candidate for an offer and compromise. And based on that, you would settle with the IRS. We've had settlements anywhere from $80,000, settled for 2 or 3 grand, all the way up into the hundreds, and everywhere in between. And it's kind of a little the strategy, it's I don't know how to put this, but almost like the more you owe, the better it can be sometimes. And I hate to say it that way, if you know what I mean, because the more you owe, maybe the more of the doubt of collectability is because you can't afford to pay it back. I'm not advocating go out there and owe the IRS a lot of money because that can get you in trouble. You can have garnishments. You can even end up possibly behind bars. So that's not the advocacy at all. However, it is important to know that this is on the table for those who may be in a place where they're struggling to make the IRS payment. So again, talk with a pro about this as well. All right, next, rental income. A lot of folks who have small businesses.
I need assistance on that because I definitely have an IRS bill that I pay monthly.
Okay, we can definitely get you connected, April. Thank you for that. Business owners, they start to get diversified. They say, well, I got my business and I'm going to buy a rental property. And I did want to talk just briefly about the rental properties and the tax benefits because a lot of people don't really understand them fully with deferred and in some cases what I call deleted capital gains. So when you buy a rental property, and there's so many other caveats. We've been specializing in rental properties since the early 90s. So we spent a lot of time in the rental space. You buy a rental property and then you rent the property out, and then the property gets naturally depreciated over this is barring also, we'll talk about accelerated depreciation with cost segregation in the advanced tax strategy when we talk about that in a few weeks. But today we're just going to talk about a little bit depreciation. So then if it's a rental property and it's residential, it's depreciated over 27.5 years. If it's a business, 39. And oftentimes your expenses for the rental property, including depreciation, will equal your income. So you have no real tax to pay on those rental properties, but you end up with a little bit of extra cash because the depreciation is being taken on the property, although you're not giving more money for depreciation. If you're paying a mortgage, of course you're paying a little bit of interest and you're paying down the mortgage. Now, depreciation, it's important to know this, it's not a true tax deduction, it's a tax deferment. When you go to sell that property, you have to, what we call recapture depreciation. You have to add that back in and pay tax on it. That's very important to know because people just think, oh, and then they go to sell a property and their accountant's like, oh yeah, you owe $10,000, $20,000 or $50,000 on the depreciation. Now there's a way around that. 2 ways around that. At least, but here's one. You die. You say, Nate, well, I don't want to necessarily just die and give up my depreciation. No, you allow your heirs to inherit it. And one strategy is that it becomes an inheritance, and then your heirs get what we call a stepped up basis. In other words, all that depreciation gets poured right back into the bucket and it hits reset. So if a property is appreciated $500,000 and you've taken $500,000 in depreciation, in other words, you've written off $500,000 and you leave it for your heirs, well, then guess what? They've now got a $500,000 property. You've taken the deduction for $500,000 and they get they can sell it for $500,000 that day, pay zero tax. there's a lot more to that, but I just want to get that on your radar if you have rental properties. And then of course there's another one called a 1031 exchange, where you can then exchange that property for another property, you sell it, and within a certain amount of time, within 45 days, you have to identify, and then 6 months to 45 days to identify, 6 months to close on a property, that you can defer the gain. So you don't always have to take the capital gain. There's a lot of nuances there. There's a lot of middle ground too. And there's other provisions. I just wanted to get that out so you know a little bit more about these rental properties and maybe some tax advantages for that. I did that years ago, 93. I bought my first rental property, and it did wonderfully. I didn't want to buy it, actually. I tried to get out of it. My realtor was like, no, you can't. You signed a contract. I was only 23 years old. I didn't know what I was doing, but it's a great vehicle if you're interested in that. All right, number 4, accountable plan. I want to bring this up very briefly because if you do have an S corp, I know we've got some folks here who do have an S corp, and once you leave the LLC realm, and you can't deduct your home office expense directly, well, you can still get a deduction through what we call an accountable plan. So a lot of people think they've lost that deduction for all of your home office expenses. Not necessarily. It's a reimbursement now because you become an employee of the company when you're an S corp. And through the accountable plan, then you can then relinquish some of those costs if you do have a home office or other business expenses that you have not been deducting. So get that term on your radar with your accountant, and let them help you to make sure you're maximizing that deduction.
Nate, I have a question.
Mm-hmm.
You mentioned for the tax deferment, there was 3 ways around it. The inheritance and then the 1031 exchange. Did I miss the third one?
No, I said at least 2 ways. Yeah, at least 2
Oh,
ways.
okay, 2.
Yeah,
Okay.
yeah.
All right.
We'll go into the advanced tax one. We're going to go into cost segregation, which is going to
Okay.
be an additional way to maximize your savings. Mm-hmm.
Got it.
Mm-hmm. You bet. Thanks for asking. All right. It's trivia time. How much money, tax money, remains unclaimed by taxpayers? How much do you think people have left on the table with the government? Is it 100 million? Is it $1 billion? Yolanda out the gate. How much money do you think remains unclaimed by taxpayers? Oh, they're coming in. The billions are coming in. If you're thinking $1 billion, you're right. Look at all that money. You say, how much of that's mine? How much of that is mine? You'd be surprised how much money is unclaimed by taxpayers, whether they haven't filed. All kinds of reasons. I've had clients who didn't file for years and years and years. And yeah, right, Uncle Sam is rich. And so, and the thing about the government is, they can go back 10 years, most cases 10 years, if not sometimes longer, to collect from you. But you can only go back 3 years to collect from them. So anything over 3 years, if you haven't filed, you lose it. So I've had clients in the past who've lost tens of thousands of dollars because they just didn't file. And that goes right back into Uncle Sam's pocket instead of ours. That law needs to change. All right, number 3, early distributions. I call this the kiss of death. A lot of people say, oh, I'm going to take some money. I had a job, and I'm going to take some money out of it because I want to do X, Y, and Z. I want to pay off my car. I want to start whatever. I want to go on a vacation. I want to start the business. Be very careful about that. People think, oh, well, I'm just going to pay my tax on this $40,000, $50,000 I have with the job and my 401k that I'm cashing out. It can get really high, up to, I've seen 40+% of that go right back to the government when you cash out a distribution. Have a conversation with your accountant first and say, hey, how much is this going to cost me if I take out this money? Because what happens is then tax time comes, you've taken it out, they've taken out maybe 10 or 15%, and then you get a huge tax bill for all of this additional money, and you're scratching your head like, oh man, I didn't want to pay 40% on this. Oh, that's a herder. So be very careful and wary about that. In fact, every major financial decision you make, you want to run it through a pro, okay? Because inevitably, the pro can help you to make sure that that's a wise decision. All right, number 2, cancel debt, get insolvent. You ever get a 1099-C? C as in Charlie? Maybe you felt like, boy, I talked to that credit card company and I negotiated with them and it was a $15,000 credit card and I got it reduced to 3. I'm so happy. Then what happens? Then you get a 1099-C as in Charlie for $12,000. And then you have to take that to your accountant. And your accountant says, oh, yeah, you got to pay tax on that $12,000. Oh, well, shoot, I did that for 10 credit cards. So now it's $120,000. How in the world am I going to pay taxes on that 120 grand? Well, there's a workaround. If you're insolvent at the time of the cancellation, in other words, if your debts exceed your assets, if your liabilities exceed your assets, it's possible that you may qualify for insolvency and to pay less, if not zero, on all of that canceled debt at 1099-C. So you may be in a situation to where that's happened in the past. You can go back up to 3 years and amend. It may be on the horizon. If it ever happens, definitely ask your accountant, hey, I heard in a workshop, in a seminar, that I may be able to take advantage of insolvency. Sometimes accountants, they don't know about it. Not every accountant knows about every tax strategy. It's just the way it is. So you've got to be your own educator in a lot of ways. And that's why you're here right now, because you're learning. And that way you can take these strategies and you can utilize them later. Sometimes you don't need them right now. They're just tools. They're tools in your toolbox in the future. All right. Fact or myth? Your dog food, your supplements, your haircuts, your Armani suits are tax deductible. Fact or myth? We're almost home free, friends. Let's bring it home. Oh, so wait, fact. I like it. I like it. But no, unfortunately, these are all myths. The IRS has and the tax courts have disallowed all of these expenses from ordinary, necessary, and reasonable. Now, if your Armani suit has your logo on the front, well, then you just may be able to make an argument for cannot be converted to ordinary use. That's the terminology that's used. I can't convert this to ordinary use. You say, well, Nate, my dog is my security guard. Yep, IRS tax court threw that out. Well, I work at a gym and I own a healthcare facility. My supplements are advertising. Sorry, IRS tax court's thrown that out. Haircuts. I have to get a nice haircut for, I've got flight attendant. No, sorry. It's all of these are myths. And we have to be very careful not to go over the line in some of these ways with the IRS. All right. And the number one last on this list, as we roll through, of tax strategies, where you live matters. You say, oh gosh, I'm not leaving Illinois. Well, Illinois doesn't have a high tax rate, but I want to show you this. You can look at the map here. The red are states that have no tax, no state tax. So you might be thinking, I kind of like Texas. Well, I kind of like it a little bit cooler. I may go to Washington State or so on. Look at the states that have the highest tax. Can you see those? California and New York and Vermont. Those all have very high taxes, as well as Iowa and Minnesota for that matter. If you want to pay lower taxes, stay out of those states. You might be thinking in the future, I want to move out of this state. Consider a low to no tax state. Now, you can also possibly have a business that is a virtual business that we incorporate in a no tax state that you may not pay any taxes out of at all. And that's, again, an advanced tax strategy talk with a pro about. And that is it, friends.
I have a question. You said which states was there in the red? What
the red is zero tax.
The red is zero tax?
Yes.
Really?
Yes. Where you want to go?
To Florida.
Florida, it is. I tell you, Florida is very, very appealing. You think about it, wow. Because if you're paying 5% in Illinois, up to 6%, actually Missouri is about 5% right now. They just changed it. find a state that, oh yeah, find a state. What state would you move to? Maybe put in the chat, what state would you move to if you could? And enjoy zero tax, save 5%. So that adds up.
You saying that the states that's in red has no taxes on what, like the things you purchase or the things
Income
you
tax.
buy?
Income tax.
Oh, okay.
Mhm. Yeah.
Okay.
So say, for example, you made $100,000 this year. Well, in
Mhm.
Illinois, you're going to write $5,000. You can pay them right off the top. Florida, you can pay zero. Now that adds up. So you say, oof, Nate, what if I'm making, big bucks, 200,000? Well, that's 10 grand you just saved, and so on and so forth. So, once you start really rolling, I mean, one day you might be making $500,000 or $1 million. Hey, $60,000 to save a year. Think about the 60 grand. You could have a nice place for 60 grand a year. It's free. Costs you nothing because you're not paying the tax on it. So those are all considerations for you, friends, as you think about how to maximize your tax savings, how to live in a way that is savvy tax-wise. This is just a scratch of the surface. Just a scratch of the surface. There's so much more, but this is a nice overview for you in some different areas.
Well, thank you for that, because I did not know that.
That's
I
right.
just screenshotted too.
Yeah, a lot of people think Florida. I think Florida too sometimes. And here's the other thing too. You can also be a part-year residence in a state as well. So you might say, you know what? I like Florida in the wintertime because it's nice there. So you can have say, for example, you have a business that can go with you. Maybe you have an online business. And so that online business then is in Florida 6 months of the year, is in Illinois or wherever the other 6 months. Well, guess what? I'm taking that half of my income and paying zero state tax on it, provided that half is earned in that state.
I just spent 7 days in Florida looking for a car on Turo to put down there so I can do business in Florida and move around when I'm down there. But to know that they don't have any taxes on the income, that is great news to me.
It is. It's a nice bonus. All right. Any other thoughts or questions? And obviously some of the things, these take a deep dive on your individual tax situation. So our team is happy to help in any way, and I'm sure we can make sure that you get our contact info sent to you as well from Yolanda and the team to get some more tax advice as needed. All right. Thank you, Yolanda. Thank you so much for hosting and bringing all these wonderful people together for this important talk. Again, we're going to have an advanced tax strategy in just a few weeks. We're going to take it up a couple notches. You're going to be like, whoa, we're going to talk a lot about the big, beautiful bill. I think that's a really important conversation because people want to know, what does it mean for me as a business owner? And we're going to dive deep.
Well, thank you, Nate. This has been very informative. We really appreciate you, and we can't wait till the next one as well. You all have a great, if we don't have any other questions, we don't have any other questions, then I guess you all can have your day back. Thanks, Nate.
Thank you so much, everyone. Blessings.
Someone had,
Thanks, Nate.
okay.
Did you
All
post
right.
the contact information for the escort for the taxes, or is that different people? Because I do have some scheduled with someone, but I don't know if that's in the same category, same position.
Absolutely, April. We'll make sure we get some contact information out to all the participants. I think, Yolanda, is that possible that we can just blanket send them our contact info so they can connect with us?
Yes, we can send it to them. Yes.
Wonderful. Thank you, April. We look forward to meeting you.
Okay, thank you guys. Have a blessed day.
Oh, you as well. Bye-bye. Goodbye, all.
Bye.
Bye.